The numbers arrive before the truth. They land on trading desks clean and confident, telling a story of growth that feels impossible to doubt. Quarter after quarter, profits rise while the rest of the telecom world stumbles. Analysts nod. Investors relax. The market listens. Inside the company, the pressure is constant. Miss the number and everything breaks. Loans get called, stock collapses, careers end. So the numbers cannot miss. They must not miss. At WorldCom, ordinary expenses stop being ordinary. Costs that should hurt the bottom line are quietly moved, reclassified, stretched into assets that promise value later. The losses do not disappear. They are buried. No forged invoices, no fake sales. Just entries made with confidence, approved with silence, repeated until the lie becomes routine. Most employees never see it. Some see it and look away. A few see it and feel the ground shift under their feet. The market believes the story because the math says it is true. But math only tells the truth when someone lets it. Chapter 1. The numbers keep climbing. By the late 1990s, the telecom boom had turned speed into a religion. Companies raced to lay fiber, buy rivals, and promise a future wired with endless demand. Growth mattered more than discipline. Scale mattered more than profit. Wall Street rewarded whoever looked biggest, fastest, and most confident. WorldCom learned that lesson early and used it well. The company grew by acquisition, swallowing long-distance carriers and regional networks at a pace few could match. Each deal added revenue, customers, and complexity. From the outside, it looked unstoppable. Earnings climbed, stock prices followed. Analysts praised the strategy and rarely questioned the details. Inside the business, reality felt tighter. Competition drove prices down. New technology made yesterday's assets cheaper by the quarter. The cost of maintaining vast networks stayed stubbornly high. Growth slowed, even as expectations kept rising. Missing earnings was not an option. The company carried heavy debt from its buying spree. Its stock price supported loans that executives depended on personally and professionally. If confidence cracked, everything else would follow. At the center stood Bernard Ebbers. To investors, he was the architect of a telecom empire, a former gym teacher turned dealmaker who preached loyalty and grit. To employees, he was distant, focused on expansion and numbers. As the market cooled, the pressure around him hardened. Each quarter came with the same question: how do we make the numbers work? The answer began quietly in accounting. Telecom companies paid enormous line costs. These were routine fees paid to other carriers to route calls across their networks. They were ordinary operating expenses. They hit the income statement immediately and reduced profit. Every telecom company carried them. Every analyst understood their weight. At WorldCom, those costs started moving. Instead of being expensed, some line costs were reclassified as capital expenditures. Capital costs did not hit earnings right away. They were treated as investments, spread out over time. On paper, profits rose. Cash reality did not change, but reported performance did. The entries were not hidden in shadow systems. They sat in the general ledger, booked with confidence. To anyone reading the financial statements, earnings improved while costs appeared under control. Internally, the explanation was simple and repeated often: timing differences, temporary adjustments. The costs supported future revenue, so they belonged on the balance sheet. The story made sense if no one pushed too hard, and most people did not. Accounting staff noticed that the adjustments grew quarter by quarter. The amounts increased as revenues softened. What began as a tweak became a pattern. The books showed strength, even when internal reports showed strain. Management emphasized loyalty and silence. Questions were framed as misunderstanding. The company culture rewarded agreement. Disagreement stalled careers. Outside the company, the market stayed optimistic. Analysts modeled growth based on reported profits. They compared WorldCom favorably against competitors who admitted pain. Investors poured in capital. The stock became a staple in retirement funds and mutual portfolios. The disconnect widened. Telecom traffic slowed after the dot-com bubble burst. Customers renegotiated contracts. Pricing pressure intensified. Yet WorldCom continued to beat expectations. Each quarter reinforced the illusion that this company had cracked a code others could not. Inside finance teams, the work grew heavier. Entries that once appeared occasionally became routine. Journal entries bypassed normal scrutiny. Documentation thinned. The pressure to close the books on time eclipsed the instinct to challenge assumptions. Some employees sensed something was wrong but could not name it clearly. The math worked, the approvals existed, no one forged signatures, no one invented revenue. The fraud did not feel like fraud yet. It felt like survival. Executives spoke about temporary downturns and future rebounds. They framed the accounting as a bridge, a way to smooth volatility until growth returned. The bridge kept extending. The shore on the other side never arrived. Wall Street never saw the internal forecasts showing flat or declining revenue. It never saw the growing gap between cash flow and earnings. It saw only the polished numbers released each quarter, audited and approved. The system fed itself. Strong earnings propped up stock prices. Stock prices supported confidence. Confidence discouraged scrutiny. Every link depended on the next. By the end of 2001, the discrepancy between reality and reporting had grown massive. Billions in ordinary costs had been shifted away from where they belonged. Losses that should have alarmed investors had been converted into assets that promised value later. The numbers still climbed. Inside the company, unease deepened. Lower-level accountants whispered questions after hours. Some asked supervisors for explanations and received none that satisfied. Others chose silence, calculating the risk of speaking against the certainty of retaliation. No one had yet pulled the thread hard enough to unravel the whole fabric. The entries remained scattered across accounts, spread over time, disguised as routine. The deception did not rely on brilliance. It relied on repetition. Quarter after quarter, the same adjustment solved the same problem. As long as no one stopped it, the math kept delivering the outcome leadership demanded. Externally, the company remained a darling. Financial media praised resilience. Investors believed they were watching a rare success story in a failing industry. The gap between belief and truth widened until it became structural. The danger was not just financial, it was psychological. Once enough people accepted the numbers, questioning them felt disloyal. Doubt became an act of defiance. The books closed on another strong quarter. Earnings beat expectations again. Stock held steady. Applause continued. But inside the accounting records, something fundamental had broken. The company was no longer reporting performance. It was manufacturing reassurance. The numbers looked clean. They looked convincing. And they were wrong. Chapter 2. Inside the silence. The market collapse did not shock WorldCom. It squeezed it. After the telecom crash, revenues flattened and then slipped. Contracts once assumed to renew quietly were renegotiated. Traffic volumes softened. Pricing power vanished. Internally, forecasts turned cautious, then grim. Externally, expectations stayed fixed. The numbers still had to land clean. Each quarter brought the same demand from above. Meet the target. Do not miss. Do not surprise the market. The language was calm, but the meaning was clear. Failure was not acceptable. The accounting work intensified. The same reclassifications that had once seemed temporary became permanent fixtures of the close process. Line costs were still moved, the amounts grew, the justifications shortened. Journal entries began to bypass standard review paths. Documentation that once accompanied adjustments thinned to brief notes. The system relied on trust, hierarchy, and speed. Speed mattered most. Inside the internal audit department, something shifted. Cynthia Cooper was not looking for a scandal. Her job was to test controls, not challenge strategy. But patterns kept appearing where none should exist. Accounts that should have fluctuated moved in one direction only. Expenses that should have risen with volume stayed strangely flat. Questions led to evasive answers. Requests for detail were delayed. Meetings ended without resolution. The internal audit team began working at night, not because they were ordered to, but because fewer people asked questions after hours. They pulled ledgers quietly. They compared entries across quarters. They traced adjustments back to their sources. The same type of entry kept appearing. Large amounts moved from expense accounts into capital accounts late in the quarter, often near the close. The timing was precise. The impact was immediate. The team recalculated earnings without the adjustments. The picture changed fast. Profits vanished. Losses emerged. The scale stunned them. This was not a rounding issue or a one-time error. Billions of dollars in routine operating costs had been shifted, not once, repeatedly, across multiple reporting periods. The adjustments had become structural. They brought the findings to management. The response was not panic, it was minimization. The entries were described as accounting judgments, timing differences. Aggressive, perhaps, but defensible. The explanation relied on complexity and authority. Telecom accounting was hard. Outsiders would not understand. The auditors were told to stand down. Instead, they documented everything. They escalated the issue to the audit committee. That move carried risk. Internal auditors depended on cooperation from the same executives whose decisions they were now questioning. Retaliation did not need to be explicit to be effective. The atmosphere tightened. Meetings grew tense. Emails became guarded. The investigation continued under a sense of isolation. The team understood what was at stake, not just careers, but the survival of the company itself. At the same time, the fraud continued. Entries were still being booked. Earnings were still being released. The market remained unaware. Each public filing widened the gap between reality and representation. The internal auditors faced a paradox. Stopping the fraud would likely trigger collapse. Allowing it to continue guaranteed a worse outcome later. There was no clean option left. The audit committee began to grasp the magnitude. The adjustments were not confined to one department or one executive. They reflected a systemic decision to manufacture earnings. Controls had failed because leadership had overridden them. The silence that had protected the scheme started to fracture. Fear spread quietly through the company. Rumors moved faster than memos. Employees sensed that something was wrong, even if they did not know what. Morale dipped. Trust thinned. Still, no public disclosure came. Behind the scenes, pressure mounted from multiple directions. Auditors demanded explanations. Internal teams documented evidence. Senior leadership tried to contain the damage without admitting fault. The fraud had grown too large to unwind quietly. Restating one quarter would expose the rest. Every correction pointed backward to earlier lies. The math trapped everyone. By the time the internal findings reached the highest levels, the deception was already embedded in years of financial statements. Undoing it would erase profits, crush stock value, and invite scrutiny that could not be controlled. The internal auditors understood this. That did not stop them. They pushed forward because the alternative was surrender. Because numbers, once knowingly false, stopped being mistakes and became weapons. The audit committee prepared for the inevitable. Outside counsel was consulted. The question was no longer whether the numbers were wrong, but how to reveal that truth without destroying everything at once. The company continued to operate as if nothing had changed. Earnings releases went out, analysts updated models, investors held steady. Inside, the silence had turned brittle. Everyone involved understood that exposure was coming. The only unknown was timing, and when it came, it would not arrive gently. The deception had relied on routine, repetition, and trust. It would end the same way it began, with a single entry questioned too carefully to ignore. By the time the issue moved beyond the building, the story would no longer belong to WorldCom. It would belong to regulators, prosecutors, and the public. And when that happened, the silence that sustained the numbers would collapse under its own weight. Chapter 3. Collapse in plain sight. The disclosure did not leak, it detonated. In June 2002, WorldCom announced that its financial statements were wrong, not misstated at the margins, wrong at the core. Billions of dollars in routine expenses had been improperly treated as assets. Earnings that investors relied on did not exist. The reaction was immediate. Trading halted. When it resumed, the stock collapsed. Confidence vanished in hours. What had looked like strength turned into evidence. Employees learned the truth alongside the public. Many had suspected trouble. Few imagined the scale. Phones rang without answers. Desks went quiet. Years of work dissolved into uncertainty. Regulators moved fast. The U.S. Securities and Exchange Commission filed a civil complaint alleging massive accounting fraud. The language was blunt. The conduct was described as deliberate and sustained. The numbers had not drifted. They had been pushed. Investigators traced the entries back through quarters and years. Each adjustment told the same story. Ordinary costs moved out of the way to manufacture profit. The method was simple. The effect was enormous. WorldCom filed for bankruptcy protection soon after. It was the largest corporate bankruptcy in United States history at the time. Tens of thousands of employees faced layoffs. Retirement accounts tied to company stock were devastated. Investors watched holdings evaporate. The human cost spread outward. Pension funds took hits. Small investors lost savings. Confidence in corporate reporting cracked across the market. If numbers this large could be fabricated so quietly, what else was wrong? Criminal investigations followed the civil case. Federal prosecutors focused on intent, authorization, and knowledge. They did not need to prove creativity. They needed to prove awareness. Senior executives were charged. Some pleaded guilty and cooperated. Others fought. The case centered on who knew what and when. At the center stood Bernard Ebbers. Prosecutors argued that the fraud served to protect his wealth and control. Defense attorneys argued that accounting details lived below his level, that he trusted subordinates, that he did not direct the entries himself. The trial unfolded slowly. Documents replaced slogans, emails replaced speeches. Jurors listened to accountants explain how simple reclassifications altered reality. They learned how earnings targets shaped behavior, how silence became policy. The verdict came in March 2005. Ebbers was convicted on fraud and conspiracy charges. He was later sentenced to prison. The decision closed one chapter and opened another about accountability at the top. WorldCom did not vanish. After bankruptcy, it reemerged as MCI under new ownership. The network still carried traffic, the lights stayed on, but the name became shorthand for deception. The case reshaped corporate governance. Boards reevaluated oversight, auditors hardened standards, laws tightened controls. The Sarbanes-Oxley Act passed in response to WorldCom and similar scandals, forcing executives to personally certify financial reports and strengthening internal controls. Those reforms came after the damage. For many employees, the collapse carried lasting consequences. Careers stalled, trust in leadership eroded. People who had done nothing wrong paid a price measured in years, not quarters. The fraud was not built on brilliance or secrecy. It thrived on repetition and pressure. Each quarter reinforced the last. Each approval normalized the next. The system rewarded results and ignored methods. In hindsight, the warning signs appear obvious. Cash flow lagged earnings. Line costs behaved unnaturally. Growth claims contradicted industry reality. Analysts asked few questions because the answers looked clean. But inside large organizations, clarity blurs. Complexity shields behavior. Authority discourages challenge. People tell themselves that someone else has checked the work. At WorldCom, no one forged revenue. No fake customers existed. The deception lived in classification, in the quiet choice to move a cost from one column to another. That choice, repeated often enough, reshaped reality. The scandal left a simple lesson with a hard edge. Numbers do not lie on their own. They lie when people decide the outcome first and make the math follow. WorldCom fell because the truth eventually insists on balance, not moral balance, financial balance. Ledgers reconcile or they break. When the books finally opened, the story was already written. The fraud had not hidden in darkness. It had lived in plain sight, approved line by line, quarter after quarter, until exposure was unavoidable. The numbers never were, and once revealed, they could not be made real again.